Good afternoon, folks. I will be checking my Twitter to see if you guys can hear me and if the audio is good enough. I have everything all the way up as far as I can get it. All you gotta do is just send me a 5x5 on Twitter if everything's kosher. Volume level good. Thank you. All right, so let's take a look at this ES market here. All right, so I mentioned this morning with tweets that we had a opening range gap from yesterday's regular session hours close to today's electronic trading. I'm sorry, regular session open by looking at it like this. Okay, so here's that close from yesterday where we opened today. We rallied all the way up into that gap at 255. Mentioned that here. I said extend that out. Note that. Well, I told you it would hit this, act as resistance, trade down into this imbalance, which was the low to high lunchtime sell side liquidity. We have the market having returned back into this fair value gap there. I'll note it. I try to keep my annotations light because I already have a lot already on the chart. So we traded up into that, and we're going to be looking for the market to trade back down into the sell side here and dig into this a little bit more. Okay, and we'll go back into electronic trading hours, and we have sell side here. Dollars firm. If you look at your 15-minute time frame on DXY, 15-minute time frame, you can see we have relative equal highs from this morning. It might want to run up into that, and then we have actual gaps in the Wednesday 7:30 p.m. time window. So it might want to trade up into that 102.50, 102.55 for dollar. That would be risk off for ES. So let's drop down into a 4-minute chart. A 3-minute. 2-minute. 1. All right, so let's go back up to the 3-minute. See how we have this really nice, easy to see SIBI here, whereas it's not so clean when we drop down to the 2-minute. I mean, it's there, I guess, but I like the way it looks on the 3-minute. And then we have a volume imbalance up here as well. So we're at the opening range gap. That's what this shaded area is down here. I'm looking for the market to try to trade back down into this area here. That will be sell side and the old daily fair value gap SIBI low. And some of you are probably asking what that is. Let me see if I can pull it up here. It is this big down close candle here, using this candle's low as the high, that candle's high here as the daily fair value gap SIBI low. Okay, so that's what I'm looking at. We got a nice big wick here, so we'll drop back down. Lower time frame. If we get animated on the downside, and we completely go back to yesterday's closing price for the opening range gap, then we can maybe consider the new week opening gap that's current for this week. And I got a question from one of the students on Twitter. How do I make my lines like this? First of all, I'm using TradingView, obviously, but when you're dropping a horizontal ray, all the settings are this, okay? So that way you can see everything. And the text is set to middle and on the right. So that way, no matter what I do on my chart, it'll always be on the right side, okay? So let's throw that in there, an extra charge. So I'm looking at the Dow has relative equal lows on its hourly chart. I'll take a look at that real quick. Right here, that's too clean. And below that, if we drop down, we have this small little gap here for Dow traders, and then we have all the imbalance in here. All this back and forth in here. You want to look past that. If it's going to drop below here, it might dig into this area down here. And then we have these relative equal lows. Okay, you see that? So back to ES. Let me do NASDAQ because I know some of you'd like to trade that one too. Okay, so NASDAQ has we have sell side here on the hourly. I mentioned the consequent encroachment of that wick earlier today. We had a little bit of wick past it, but so far it's been doing okay. And then let's go back to ES now. And 5 minute. 3 minute. So today is obviously the immediate day after FOMC, and whenever we had an FOMC event or a large range event, a lot of volatility and such, the very next morning session, you don't want to be doing too much of anything. Doesn't mean you can't paper trade, doesn't mean you can't study, obviously, but too many individuals want to go in here and try to chase it with their funded accounts or their live accounts, and it's many times proving more difficult for them, especially if they're not used to seeing the type of price action that's following a large range or high volatility event. So plenty of time, that last hour of trading, I'll commit to spending time past 3 o'clock until we get something that would be noteworthy. If something happens and I miss it and I wasn't able to call it out live, then it'll be just a missed opportunity. But my bias is bearish. I don't look at this as going higher. I have nothing in here that wants to see a buy side run. Now, when we have these opening range gaps, it's important for you to obviously treat them the same way I teach you to use all of the gaps that I like to use in technical analysis. They're not one and done, okay? So we extend them to the right. So right now what we've just did, we've taken out sell side right below these two relative equal lows. Now I want to watch and see, does it come back up here and touch the top of that opening range gap? If it does, we would watch that to see if it wants to expand from that point. It may not do that. It may not do it at all. But I'd like to see it trade up to that level there, and which would also be what? Look to the left. What do you see? Consequent encroachment of that wick. So if it trades to that level here, hits it, then expands down, we would expect for sell side. We also have a gap in here. So we would like to see that trade down below it, come back up and act as what? Resistance, as I've outlined that this one would be this morning, or this afternoon rather, and we've seen it happen in the PM session. Then traded softer, and let's drop down into a 1 minute chart now. See the volume imbalance here at the top of that shaded area as well. All I've done is shown the range between previous day's close, regular session, to the opening price at 9:30. So that's this range here. That's what's being indicated. Okay. So watch the volume imbalance in here and the high. There really is no need for it to get up into here. Even though you see this here, I don't think that it needs to get up there. Sorry, I know those water bottles are noisy. So I'm looking at dollar, and I'm still favoring that run into the, let me actually give you a level. You can look at it on your chart. 102.45, and then the gaps in yesterday's opening. We started trading again around 6 p.m. There's a gap up in that area around the 102, what is that, 50? Yeah, 102.52, thereabouts, up to here. Try to get my chart here to show up. Yeah, 102.52 and 102.45. So in that range, there's an actual liquidity void for dollar. So that may act as a draw in addition to the buy side that's resting above 6 a.m. and 8:30 highs for dollar on the 15-minute time frame. So if we can get some kind of a run up into that, again, that would be risk off. So that would allow for price to trade softer. Okay, so we were able to get back up into this area. I didn't want to see it do that. I definitely don't want to see it up in here. I want to see it kind of stay heavy in here. We're in the 2 o'clock hour. NASDAQ looks heavy here. It has a fair value gap, discount fair value gap at, and this is going to be on your 5-minute chart for NASDAQ, the 9:25 a.m. for today. That's your fair value gap, buy side imbalance, sell side inefficiency. You want to draw a rectangle on that, extend it to the right. That puts you around 12,837 for NASDAQ. All right, so now I would like to see this candle that's forming right now. We're on a 1-minute chart as a reminder. I'd like to see this candle close, leave this little bit of a gap here, trade up into it. It doesn't have to hit the high of that shaded area, but then I would want to see it go into the area and then sell off going into the sell side right in here, okay? Okay, so now we have the range there. Let me zoom in a little bit on that. I don't want to see it run away yet. I want to see it pop just above this candle's high. So trading at 95 even. If it trades at 95 even or 95.25, we watch that with a hypothetical stop loss above here and look for sell side. Otherwise, it's probably just going to run away without me, and that's fine. Plenty of time still in the afternoon. So you guys got to see me earlier in the week show the doubters that buttons can get pushed with precision, huh? I have a whole lot of other things I'm going to do this year that a lot of people have said I would never, ever do. It would never be seen. I have a lot of stuff like that for the rest of the year. All right, see how we're trading into that gap now? Okay, so you want to kind of screenshot your chart like right here. Right there, that's good, just like that. And then monitor how it trades from here. Again, we're looking at this level down here as the draw. So like imagine a magnet down below here and price being drawn down here. That's kind of like the analogy I use when I teach my students. Now, days after FOMC, when we have a very large range, it's important to remember that there's a different degree of precision that is lacking in days like this. It doesn't mean that you can't find things to trade off of. It doesn't mean you can't find setups. It just means that the market tends to be a little bit more reluctant to just run away for you in your favor. Many times you'll get retracements farther than you want to see, a lot more consolidation than you want to endure. And it's very frustrating, especially if you're accustomed to seeing very quick, low resistance liquidity run conditions for your setups, which is what you should be looking for. You should be looking for that in price action and trying to get those types of setups predominantly in your studies or in your executions. Watch that wick here. Consequent encroachment there. We want to see this candle turn bearish. That would be a confirmation. So when you're watching price, these are types of things that I'm looking for that are signatures that I like to see. It kind of keeps my mindset on if I'm bearish, like I'm holding that opinion here. And we're looking for, or I'm looking for, let me make sure I'm very clear about that. I believe that we're likely to draw down here. Because of that, I want to see what would be considered a premium array, things that would be acting like a classic resistance idea. My PD arrays, for instance, like these 3 consecutive up close candles, that's a bearish order block. Then you have the consequent encroachment of this wick, which is a gap. It trades just a little bit passive, but that's fine. And we also have the fair value gap here. We traded up into that. And we moved away from the high end of that opening range gap. So we're watching to see this price remain heavy. Or if it retraces, we have to wait until we get closer to 3 o'clock hour. My suspicions is really lining up with, before we come to the close of today, I think we'll be down below here. At some point, I think we'll work this level here. But I kind of want to spread this mentorship experience across different times. And we're doing a lot of the AM session, which is convenient for a lot of folks and less convenient for the folks across the pond for this time of day, because it's a little later in the day. A little bit more of a sacrifice for them. But I will be doing some London session things as well, so that way we'll be up and watching that time of day a few times before the close of this mentorship in November. So that way it gives you kind of like a comprehensive approach to looking at a full 24-hour market day. And that way you may not be all that thrilled about any one particular session right now, but that might change because you may want to do something in your personal life that allows you to make a change for you to trade in the London session, which is a very, very difficult one in the United States. You have to really be willing to change your sleep schedule many times. So far, I'm not seeing anything in dollar that is confirming that it wants to go up into that buy side, which is allowing ES to struggle with a run lower. There's a small little dollar 1 minute fair value gap. It's a buy side imbalance, sell side inefficiency on the 146 candle for Dixie. Just now trading into that. So we can snap higher on dollar, preferably here. And that would lend well to lower prices on ES. Dow is still struggling with its sloppy little consolidation on its 1 minute chart. Volume imbalance, we've traded up into that here on ES. So you want to have that on your chart too. The volume imbalance is my PD array where there's a separation between two candles and their bodies are not touching, or at least overlapping, or I said it wrong. If the bodies of two candles consecutively, right after one another, if they aren't touching at least, there creates this separation. Even though there's a wick here that goes down into this candle's body and there's a wick on this candle that goes up into this candle's body, that is a volume imbalance. And the market tends to go back up into those areas, revisit it, reprice it, and then move away either in your favor or against you. I don't mind the volume imbalances being traded through. That's one of the very flexible PD arrays, which makes it unfortunately difficult for students to learn because you want them to act like, an order block or a breaker where it's very finite. It does this and nothing else, that type of thing. But you're also learning that all of my PD arrays have a inversion aspect to them. So when the narrative changes, what used to be a bearish PD array can be utilized as a bullish PD array. So it provides real context to the classic view of support and resistance. What I'm not doing in classic support and resistance, I'm showing you the actual underlying pinnings of the market that creates that buying or selling idea with support or resistance theory without leaning on the classical find an old low, find an old high. I'm not doing that. I'm showing you within the context of price delivery. So now watch that volume imbalance again here. We keep digging up into it in here. Dollar just was not having any of that buy side imbalance, so it hasn't provided any kind of support yet. It's one more PD array in the form of a volume imbalance, and it overlaps with a last down close candle on the 1 minute chart. So we're in that now. For dollar, but it doesn't look like it's going to do too much for us here. Now, because it's a little bit later into the 2 o'clock hour, almost 2:15, it's 2:13 now. Because we've been drifting lower, it's okay for this market to want to rally on the short term and revisit all of this area now, because we've broken several lows. We've taken this low out with this low, with this run here. Went lower again, went lower again. Did we see any follow through on the downside? No. So it's short-term oversold without an indicator. And if it's going to go up, is there any imbalance in here? There's this one. And we'd have to watch and see, does it want to respect the high end of that opening range gap, which is this shaded area? It can go there, have a little bit of a wick through that, and that's permissible, that's fine. But I would be, because of the time, I would be willing to allow for now that run above this short-term high here, because we have relative equal highs. Stop losses are going to be what? Trailed lower. So there's a small little pool of liquidity in here. And if the market trades up to that point, we'd want to watch and see, does it quickly reject that level and start going back down again? If it were to do something like that, then the next pass through this low here should be accelerated, and it would quickly want to get down into that liquidity down here, so it wouldn't be the opportunity to be pulled away from the marketplace. In other words, anyone that would have a stop loss down here in the form of a sell stop, whether to sell short on a breakout lower or trailing it or keeping it there from this morning because they're a long-term position trader, they are just waiting to be engaged. So when the liquidity gets taken, should it trade down here, all those sell stops become a market order to sell at the market, which would be a real good reason for the market to be covering shorts there, because there's a plethora of willing sellers at a lower price where shorts can buy back their short positions from those willing lower sellers. This, again, is a reminder. This is the type of day where, yes, I can see setups. Yes, I can point them out to you on Twitter. But it's more meant for you to see how different, how much more difficult price delivery is in days like this, where it's right after FOMC. It kind of like is a reoccurring theme this year in this mentorship with you all, because obviously I've taught how to find the good setups in all the core content, the videos and lectures I've done on YouTube. But sitting with me over real-time price action and outlining what constitutes a low probability condition, what constitutes a high probability condition, and training yourself to what, understanding what it feels like while you're watching price when it's not a good, really easy low resistance run condition where the market just rips in your favor. You don't have any drawdown. It's quick and goes right to your targets. That's what I'm training you to look for. That's what I train my students to look for in price action. And we're back at the high of that opening range gap. High. And as I mentioned before, it could spike up through that and take out this high, maybe in here. And then I'd want to see it reject that, not keep wanting to climb up. That's not what I want to see here. In fact, if it were to do something like that around and before 230, 240, that would be, in my opinion, reason to anticipate much more than just the opening range low as the last hour of trading opportunity. I think we could, again, revisit the new week opening gap of this present week here, if it were to do what I just outlined here, which would be spike up, clear this here, and that would give smart money the opportunity to sell these buy stops that are being trailed on short positions, and then by being short here, selling to those buyers, buying below here, buying down below here, and then buying at the new week opening gap high that's below, as I mentioned there. Okay, that's what I see as a possible scenario going into the close today, and the reason therefore why I would expect that. But the real hallmark to this year's mentorship is I'm spending my last year teaching in this capacity. I don't want to be doing this, once I get to the second week of November. It doesn't mean I'm going to fall off the planet and not communicate with anybody, but it just means that the level of engagement that you guys are used to now won't be so high. But it's important for you to be able to see what it looks like when the market is fickle. Okay, when I say it's fickle, it's very hard for a new trader to trust in these environments, which is understandable. The mature students of mine that have been with me for a while, and they know how to find low resistance liquidity run conditions where the market just runs real quick, has those explosive price moves where they have the big ranges and they don't even come back and fill in the ranges. It just keeps on going and going and going and going. Those types of moves, you learn how to find them by looking at these types of days and these types of conditions. And yes, you can make a career out of trading in these environments, but my question is why would you want to do that when there's days where you can go in there and inside of 20 minutes, your entire day's done? Whereas something like this here, you have to babysit it for a long period of time. It consolidates, it retraces, it does a lot of things you don't want it to do. And the whole time you're in these types of days, you're expecting the things that you learned in books to pan out. All these patterns and things, continuation patterns. And it is very frustrating if you don't know what you're looking at, because you're trying to project your expectations about how the market is likely in your best favor to perform, but it's reluctant to do that because, hang on one second. These stupid batteries are rolling off my desk here. You have to submit to a lot more frustration in these days. So if it's your goal to look for days where you go in there, you do the least amount of time in front of the charts, which is always a good thing, especially if you know what your model is. In the beginning, you have to submit yourself to a lot of this. Okay, you're going to have to be in front of the charts, studying, looking at old price moves. That's my back testing. It's not going in there using market replay. That's something entirely different. But you have to take a lot of screenshots and study. And then when you look at the charts, you want to write on them how, if you could go back in time, being shorted at an old high after it took out a previous high. And you classify that as a smart money entry on going short. And then you would look at the chart and say, okay, if that was the case and that smart money entity is going short there, where's the ideal scenario for them to look for an opportunity to get out of that trade, which would be below an old low where sell side resides, or a discount inefficiency. The next inefficiency, if you go on ES, on your 1 minute, I'm not going to move my chart because I want to keep it right where it is. If you look at your chart on the 1 minute, on the 910 candlestick, there's a small little fair value gap there, and it's in the form of buy side imbalance, sell side inefficiency. You want to draw a rectangle on that, extend it to the right. It's essentially 39.85-ish, thereabouts. So that's the next drawdown. Now that right there, what I've told you about trading back up into the high end of that opening range gap, that stuff's not in books. Okay, that's not, nobody's teaching that. They're going to teach it now because I'm showing it to you. But that in itself right there, that's perfect for a 5-handle run right there, and that could be your entire model. Or you could wait for it to trade down to that 39.85 level I mentioned this a moment ago, which is the next inefficiency. Then the sell side is at 39.82.5. But high resistance liquidity runs like this, see how it moves a little bit, then comes back, rebalances, moves a little bit, comes back, rebalances, moves a little bit. It's very, very, to me, you know, I'm bored by this kind of stuff. Like I don't, and not in the sense like, I mean, all of it's boring to me because I know pretty much what it's likely to do. But when it's like this to me, I'd rather do something else. I'd rather read. You know, I'd rather go do something else with my family members, take my dogs for a walk, you know, whatever, and not be in front of the charts. And you might not feel that that is something you would want to do because you look at this and thinking, this is making perfect sense to me. It went up into that fair value gap you talked about here at 2 o'clock, here. Traded up into the high end of the opening range gap high. It did that. It broke lower, came back up, and displacement to the downside. That in itself is 5 handles. You can literally replace your job with just that move, that by itself. It's all it requires. But unfortunately, you see me doing 100 handle moves, 50 handle moves, 30 handle moves, 20 handle moves, over and over and over, example after example, and you think that that's what you want to do. That's what you want to do because you see the hypothetical paper trade results in the monetary sense, and you think, if I could just do that. Whereas if I'm trying to teach this skill set to you, I want you to be able to feel confident that you can find the least of all things consistently every single day. Even in hard days like this, these types of setups form continuously. And when you sit with someone that can talk about it before it happens and explain the logic behind it, and you get to see it, experience it, that's mentorship. It's a very comforting feeling because there's no emotions behind it. There's no necessity for it to be profitable. There's no concern for it to be incorrect. You're studying it. You're learning how to submit yourself to it because the market's going to do what it's going to do.
And you can't hide it. There's your 39.85. It's almost like a dog whistle, isn't it? You know, come to daddy. Go down the sell side, 82.50. That's where it's resting. And I want to see it. I would like to see it rather spike through 39.82 and a half, and get into that 39.78 and a quarter. At least touch that again. That would be cool. But how we trade, if at all, to or through 39.78 and a quarter, that is indicative of how we trade going into the close, in my opinion. Dollars found its wings here. I had to take out that short-term low right around that 143 time window. What is that? On a 1 minute chart, took out the low. Yeah, 142. So I'm back to wanting to see that 102.45, 102.52 for dollar. Should allow for that sell side on ES that you're looking at here to get tagged. NASDAQ's nice and heavy. I mentioned that buy side imbalance, sell side efficiency on its 5 minute chart. It's at 925 this morning. You should have that extended out to the right. And here is your sell side being delivered on ES right about now. So Dow has finally rolled over, gave up the ghost. It's now accelerating to the downside, which is good. You want to screenshot this, folks. Screenshot this, and then when it hits the daily fair value gap SIBI low, screenshot that one as well. It's almost like it's pre-recorded, isn't it? Oh, you folks. It's boring, isn't it? It's like a Groundhog's Day event. You ever see that movie Groundhog's Day with Bill Murray, where it just repeats over and over and over again? That's what it's like in this community. We look for the same things to happen all the time, and it's fun. We don't get animated. We don't get crazy about it. We don't flip around and get all hopped up on goofballs. But it's just very relaxing. It's meditation for me, and I'm sure for you, it's like a thrill ride because you're seeing something being proven every single day. Every day. Precision, delivering consistently. There's no mumbo jumbo to it. It's based on real logic that the markets are going to work off of and how they book. So that was the price run for this afternoon. I know I said I would try to stay with you until a little bit into 3, but that's about as much as I would want to have as an example, trying to push you into something. The remainder of our time here, I want you to think about what is more likely to occur here. Is it more likely for the bottom end of that shaded area, which is down here? Is it more likely for that to be traded to here next, or for it to come back up and take out this high? What do you think is more likely to occur? Don't be afraid to, make a choice and be wrong, because this is what you're doing this year with me. You're watching price. You're supposed to be watching this without any kind of, and I know some of you already shorted this. I know some of you probably already tweeting to me saying, high five, woo, we're going to the club. I don't want to see that. That's why I don't look at Twitter while I'm talking to you, because I know invariably I'm going to see something that's going to get in my head, and I'm going to be worrying about you doing something based on what I'm saying, which is what you shouldn't be doing. Don't trade on this advice, because it's just me talking about price action. I'm teaching you how to submit to this process. I'm teaching you how to read price action, why it should do certain things, why it shouldn't do certain things. And because you're going to see example of this every single week, every single day, whether I'm doing it live or whether I'm talking about it in Twitter, where it's all time and date stamps and I'm taking your attention right to specific candles, you're getting a comprehensive learning experience that you can't really get anywhere else. Okay, it's one thing to listen to somebody talk about, okay, here's a signal. I'm buying here, I'm selling here. This is my target. But you don't really know why they're doing the trade, which begs the question, why are you even doing that? Like, how do you know what you're doing is going to pan out? You're basing your belief system, your religion revolves around the person that you're trusting that signal or derives from. And to me, that makes no sense. Okay, so we've traded down into that SIBI low, which is what I wanted to see. So now it should have no difficulty at all trading down into the low end of that shaded area here. And it should remain heavy. Heavy is like where it just keeps wanting to go lower, having really no interest at all, wanting to go higher. Just for purposes of later on in reflection for me as the mentor, Give me your feedback on what it feels like seeing this unfold like this. Understanding where these turns could form, how much it could trade, higher up, and if it was to do so, what that would indicate, how to anticipate where the market's going to gravitate to, draw to, which is the number one thing you're trying to learn first, and throughout the process of you discovering what your model is, and as a trader, what you're going to do, knowing where price is going to go. That's your number one goal, because everything else outside of that is going to get you in trouble. Order blocks, fair value gaps, all those things. If you don't have the direction right, and that doesn't mean bias, okay? It doesn't mean bias. It means where's the next draw on liquidity, because you can trade without a bias, okay? I saw a tweet, and for the life of me, I apologize. I can't remember. I believe the person's name on Twitter began with a F, F-E something, whatever. They asked, is it important to have a bias to trade intraday, or must you have an intraday bias to trade? Or can I trade just the internal intraday liquidity? Once you understand what you're looking for in the aspects of time of day, and when certain macros come in, and again, a macro is knowing where the market's likely to draw to next, what liquidity, and the time. So you have to know really what you're looking for liquidity, and who's been making money right now. That's essentially what the macros do. They roll against who's in the money right now. That's what their function is, because whatever movement in price action that's been unfolding is of recent, whether it be a 1 minute chart, 5 minute chart, 15 minute chart, whatever, at specific times of the day. And yes, I will teach you these macros, okay? And I know it seems like I'm not trying to do it. I am, but I'm teaching you other things that will help you when I do the lecture. You're like, oh, now, okay, I understand what he means now. Because if I do it prematurely, all you're going to do is have 1,000 more questions that you're going to clamor to me on Twitter, or send me emails that I'm not going to reply to, or talk to me through TradingView, because there's too many of you coming at me asking questions that I physically am one person. I can't do that. So you have to submit to the way I do things, which unfortunately, even my paid members, when they came to me, some of them were impatient. They thought they knew how to learn how to do this without even knowing how to do it. And they would get frustrated and quit and run away and think that it doesn't work because they don't have the patience to listen to someone that knows what they're doing. You want to be mindful of certain things that I'm talking about in the daily range, the weekly range, and how these intermarket relationships tie together at certain times of the day. When you understand those things, and then I introduce the macros and explain to you what they are, why they form, what their purposes are, it will make perfect sense to you. And you'll anticipate these things happening in the market. You'll know exactly what is going to most likely occur at that interval right now. In a 20-minute span, you know that there's going to be a setup forming. You could set your watch to it. You can sleep in and say, okay, I don't care about anything else. I'm going to go right in there. I'm going to trade based on what I see within that 20-minute window. And then find your 5-handle, 10-handle move, turn off your charts, and go back to doing whatever you want to do. And folks, nobody teaches like that. They want you to follow these moving average crossovers and trend lines and all this other stuff. See, we're below the opening range. Gap's low, see that? So now our attention goes to the new week opening gap high. If you look at the range from here to where we are right now, half of that is right in here, thereabouts, okay? So if we looked at this high down to the new week opening gap high, that's also about halfway, which would be what? Like a measuring gap. So when I look at targets where I've already outlined, I said I think I'd like to see this level traded to. That's one part of it. Also, because we have left this gap here, this fair value gap here, I'd like to see that stay open. Why? Because it happens to fall about midpoint to where my next target would be, which I told you earlier when we were up here. I said I'd like to see it get through the bottom of this. If it does, we'll gravitate down to that new week opening gap high. But because we have this range high here, which is the opening range gap high, and I understand that this feels like 1,000 things swirling through your head. What gap is what? What are you talking? I have lectures for all of this. But it's important for you to see me discuss them real time because there is logic behind what it is I'm teaching you. That way, when I'm putting a video up that's pre-recorded and it's all the theory behind it, you'll remember, oh yeah, that's what he was talking about. And he has lots of examples of that. And you can go to these live streams because they're recorded. Click on my little live tab or go into the 2023 mentorship. That's where they're being added to as the playlist. You'll be able to go through and hear me talk about these things. And it was over live data. It wasn't pre-recorded. It's not cherry-picked in hindsight moves. It's not market replay. Everything's here for you to see it was happening in front of everybody that's watching it. But if we have a target and we know where the inception of a price move should form, which was, again, at the high of this opening range gap high, remember I was mentioning, I said it would be permissible for it to spike up into here. That would be fine. It would be better had it done that and then started the break lower because, in my opinion, we would have already been trading at the new week opening gaps high down here by now if it would have ran up and took that high. But it's not necessary. So if you were trading this, you would have to trade with leverage going short at the opening range gap high, but allowing for a run above this high here and this high here, which can be scary. Or you would wait for it, had it done so, if it would have spiked up there and broke down, you would wait for the standard fair value gap to go short inside of, and then ride it down to the opening range gap low, and potentially if it goes lower down into the new week opening gaps high. So you don't see the benefit of doing that or even understanding that if I talk about it conceptually in a pre-recorded video. If I give you rules about this is what you can do, this is what you can expect, what's going to happen is, because there's so much information on my YouTube channel and there's so many different videos, it feels overwhelming. Like, where do I go with all this? Like, this is a lot of stuff. You should be in these videos, the live sessions, because I'm literally holding your hand, and everybody that's watching all the older videos and not watching these and thinking they can come back to them later on, you're doing it incorrectly. You're doing it absolutely incorrectly. You don't want to push these later because this is what people paid me for. When I was teaching mentorship, I was doing this. And because, like some of you are new, you want give me the short sell entry, give me the stop loss, give me the target, get me into a trade. My first round of intake for mentorship was very frustrated. And I lost a lot of people going into month 2 because they wanted that spoon feeding, give me a trade type thing, even though they signed an agreement knowing it wasn't that. We were watching and studying price. You should hopefully, because you've seen many examples, and that's how everybody finds me. They see what my recordings are done, like their executions. You want to see how I'm doing that. Well, I'm doing that right now, explaining it with real-time charts. I'm telling you where the logic is, what is in my head, what the algorithm should do, why it should do this and why it shouldn't do that, and where it should draw to. And I'm giving you the points of reference, how I get to that. This is the level I think it's going to go to. So if you don't watch these videos, or if you can't sit through them because it's a lot of talking, you think it's a lot of this, get to the point. The point is I'm teaching you. I want you to know how to do it correctly. I don't want you learning from somebody else on YouTube that doesn't know how they're doing it. They're getting lucky, and once in a while they have an event that makes them seem like they're consistent. You have to simply sit down with them every single day. If they're going to do it and be willing to do it for you, do it every day. If I'm not here live on YouTube, I'm doing it live in Twitter. I'm constantly bombarding you with evidence that this stuff repeats over and over and over again. But you're not going to appreciate it unless you understand what the purpose is. The purpose is for you to desensitize yourself to the fluctuations in price. And trust me as the coach that's going to put you in conditions that's going to be favorable for you with a model that you don't really know that you're going to be using yet. Because there's certain things that you probably want to do right now, like you want to trade fair value gaps, or you want to trade breakers, or you want to trade something else that I've taught. Many times my students have come through that because they watched my videos leaked on Telegram for years. They were out there, and they're still out there. And they thought they understood what they wanted to learn when they finally said, I'm going to go right to the source and I'm going to sign up with ICT and join this private mentorship. And no, you can't do that. And no, I'm not doing future mentorships. And no, I don't want your money. And all. I'm teaching you right now. I'm actually teaching you better live like this than I did, because I don't have any of you constantly asking me questions like I had when I had 865 people in my first class. They were asking tons of questions live. I can't focus. Nobody could. Nobody could do that. Nobody can do that, okay? And it was very frustrating for me. I was overwhelmed with all of the, the fever that everybody was asking, because I want to answer everybody's question. And when you send me emails, I want to be able to do that, but it's impossible. Like, look at the comment sections of my videos when I open them up. I can't sit there and answer all those replies. I would never get anything done. I'd be divorced. My wife would be like, I don't even know you anymore. I already spend too much time with you as it is. So I try to do as much as I can, and I think I outperform everybody else out there in education, whether paid or someone that's charitable like I am now, giving it out for free. We're getting ready to hit that new week opening gap high. It's almost like it's written in the stars. But when I'm talking to you, I'm lecturing you because I want you to understand why it is that you should be submitting to some idea that I've taught or am teaching. Because if you don't know that, you won't know what to reach for when it's not moving in your favor. And when we're here consolidating like this, some of you probably thought this dropped down here and said, oh, it's got a pin bar. Oh, look, it's going up. And you were thinking it's going to reverse and go back up and fill this gap. You know who you are. You were hoping it was going to do that because I said it was a measuring gap. I taught you what a measuring gap is now. Inception of the move here. Terminus. Halfway, right in here. Where's the gap? Right there. What kind of gap's that going to be? Measuring gap. Measuring gaps don't fill. Just like breakaway gaps don't fill. But what happens if you do get a measuring gap and it happens to trade up and fill in? Doesn't matter. I'll still treat it the same way. So see what I just did there? How do you know when a measuring gap forms? I just taught it to you. You have to know where the beginning of a move happens, which I explained to you here. Where is it drawing to? Well, you have a couple things you got to look for. I told you the 39.85 level was the fair value gap, and we have to see how we trade there. Well, it traded down into the 39.85, then consolidated, broke lower, traded to the low of the opening range gap, low, rallied a little bit, consolidation leading to what? This is when your classic continuation patterns work. This is a bear flag. But I also teach when those flags are fake and you can fade them where other traders would be caught offside. That's what's in my core content. So when I'm teaching you and I'm trying to give you all of this experience that I have, it's for you to understand what your mind should gravitate towards when you're feeling scared about holding on to the idea that you're in. Watch the consequent encroachment now, here. It's this level here. It's the midpoint between this week's current new week opening gap. But if you don't have any experience and you're in the trade, I mean, you know what it's like. You probably got lucky enough to get a funded account challenge passed, or you had a live account that you opened up prematurely, and you put on a trade, and you think you know what you're doing, and then all of a sudden, you can't breathe. The market's not moving for you. You're not stopped out, but you start guessing. What's going to happen next? Am I going to get stopped out? Is it going to turn against me? What is normal? You don't know that. Why? Because you've not done what I'm doing with you here this year. That's exactly why my students that paid me fail. They're lazy. You don't want to be a lazy student. You have to be doing these types of things. I'm out here publicly proving that these things work. There's nobody that's going to be able to stand in front of me, whether in court or in public forum, going to say that these things don't work, because I'm absolutely proving it. I'm cramming it down your throat. I'm stomping on your neck with it. There's no way anyone can say this stuff doesn't work. There's not any sound logic to it. There is absolutely sound logic to it. This is algorithmic price delivery. It's undeniable. These things repeat over and over again every single day. But if you don't want to listen to me, there's the consequent encroachment traded too. If you don't want to listen to me, you don't want to go through the proper learning experience, what's going to happen is you're going to go to Jim Bob's Dollar Menu Mentorship on YouTube. Okay, you're going to go to their Discord. You're going to go to their Telegram channel. You're going to go and follow whatever they're doing. Okay, their Zoom calls or whatever they're doing. Okay, and they're going to tell you, they're going to give you the 5-minute spiel on ICT. You're going to get into trades. You're absolutely going to do that because they're using my logic. They're not teaching you. They're parroting what I've done, what I authored. But they don't have the 30 years experience to guide you when the shit's deep and you have no idea what to reach for, what to trust. I'm sorry, folks, but plan your trade, trade your plan, that stuff doesn't work all the time. Especially if you don't know what the hell it is that you're expecting in price. You don't know when a certain series of candles is a real reversal yet, or just a simple consolidation or retracement to go lower again, or go higher if you're bullish. You don't have that yet. And these new guys that are teaching my stuff, they don't have that experience either. All of their funded students are funded because I spoke. That's how that worked. And these individuals that are trained to use my stuff from someone else, they won't be sustained. They'll lose their funded account because they're not learning with 30 years, 3 decades of experience. I've sat and watched these candles paint for 3 decades. I've had good days, I've had bad days. I've had good months, I've had bad months. I've had good years, I've had bad years. And I can tell you the story, what price is going to do on second interval charts. 1 minute chart. I do that because I want to make sure that there's next to no time for someone to take what I'm doing, unless you're clearly just taking my chart or whatever it is I'm doing, just reposting it somewhere else, pretending that you're me. But it's such a small interval. By the time someone that wants to take it and then put it in their Telegram channel and say they're doing it, it's already moved. You have to be right here under my wing. That's the number one reason why I'm teaching with a 1 minute chart. I'm removing any chance for all these copycats out there. And I'm giving you my time. I'm giving you my energy. I'm giving you my wisdom. And I'm telling you how I hurt myself in this business. I'm telling you how to prevent it from hurting you. And you would want to learn how to do that. If you were really trying to do this and you were honest with yourself, you would want to know everything that I'm willing to give you. And unfortunately, that's going to come with a long-winded delivery because there's a lot of stuff that took place in the last 3 decades that I learned from that isn't in books. So if you're here to learn, I promise you, you're going to learn things that no one can teach you. It's not anywhere else. I don't care who tells you they can do what I'm doing. They're not going to do it. I'll be here all year doing this. You might see 1 or 2 events by them, but I'm going to tell you exactly what price is going to do. And by the time we get to the second week of November, you're not going to need me. You're not going to need ICT. You're not going to need me to talk to you on Twitter. Watch the new week opening gap low as our next objective, which happens to be this low to that high measured move down to there. So that'd be a nice little run. If it does that, I will close the session with that. But you didn't push a button, ICT. Oh, I'm pushing a lot of buttons. A lot of people listen to me talk today. They don't like this. So yeah, I'm pushing buttons. But I want you all to succeed. I want you to do well. And I want to have a clear conscience when I step away from all of you in this capacity in November, that I've given you all that you need because you spent time with me over live data. If I didn't know what I was talking about, if I didn't know what the price was going to do, first of all, you wouldn't be watching me. You would already turn this video off. You would turn the stream off and go watch something else. But you know what's happening because you're seeing it happen in your chart. This is live data. It's real time. You can't fake it. It's right there. And everything's already on the chart. So it's not like I'm adding something to the After Effects type thing. It's not photoshopped. Everything's here. The logic as to why it should do it, I'm filling in all of that while I'm talking to you. So that way, when you ever get to the point where you make the decision, you do this on your own, but if you ever make the decision where you want to trade with real risk, whether it be a funded account, whether it be, real money of your own, you won't feel lost when you're watching price action. All these things will be familiar to you. Oh, this is normal. Price should do this. Where the average neophyte, someone that's trading with retail logic, they see a candle like this and they think it's the end of the move and the world's ending and it's going to be a break your neck reversal type thing. You won't feel that simply because it's happening in a chart. Up close candles is a good thing. If the market's going lower, we want to see that form, because eventually if it trades down below it, it will revisit that as what? A bearish order block. And you want to see that repel price lower. So when we're bearish, we're not afraid of green candles forming, even if they're big. That's the reason why I teach the way I teach with my stop loss management. I teach all of my students, do not jam that stop loss up. Don't even worry about that stop loss. It's being paid to do its job. Your job is to watch price. Is it constantly giving you instant feedback that you're on side? Is it doing things that is acceptable based on how I teach order flow? Do you see a depth of market over here on the right side, over here at New Ladder or something like that? No. Everything I've read in these candles is just the price itself. Knowing that it's likely to gravitate towards the levels I've called out here. Focusing on the time of day that it's going to draw down there. What's it doing? It's rolling on those individuals that made money this morning. How did they make money? Being long. So all of this move here is to do what? Remove their chance of profit. But I had my stop loss below the low of the day. It should have never came back down here. And yet it did. It shouldn't do these things. My technical says this. My indicator says that. It shouldn't have done these things. And yet it did. I'm giving you all the insights so that way you don't wrestle with these real concerns. I'm not trying to dismiss them. I mean, they're real things to be considered while you're trading. You got to manage the trade. You got to manage yourself. But how do you manage yourself? How does ICT get on here or go on Twitter and feel confident about the things I'm talking about and say, look at this, look at that, wait for these things to happen, and it happens? Because I've been here before. I have an internal dialogue that I'm communicating to you. So that way it'll adopt this comfort. Not completely stress-free, but you'll feel comfortable because you've been here before. And you'll hear my voice in your head, which is what I refer to myself as the ghost of the machine. Your brain is the machine. That's the mechanism between your ears that you're utilizing that comes up with these decisions to get in and get out. But once you get in there, what you're lacking right now, because most of you are new, is you don't have experience. So when you're spending time with me, live streams like this, or listening to my Twitter spaces where sometimes I talk a little too much in colorful language, and I'm trying very hard to stay balanced in this one today. And I'm literally doing everything I can to keep from going off the rails because I am bipolar, and it's very hard for me to do this live and not do that. But these talking points, these things that bore most of the young folks, your youth is a disadvantage for you in that regard. The folks that have been trading for a long time and have had break even, hit and miss or unprofitable, when they hear someone like me that have spent many years doing this, and I have experience in being able to do it correctly, when they hear that, it fills in all those potholes that they experienced that caused them damage over the time that they tried to make money in the marketplace and struggled. Because these things are not, even in Mark Douglas's book, as good as it is, he's not going to tell you how to submit to these ideas, because those ideas that I'm talking to you about, they're mine. He's not privy to that. Market Wizards books, those guys and gals in those books, they're not privy to this information. This is mine. So I'm the only authority that you're going to have to learn from. Despite everybody else out there trying to be equal to me with my own creation, they're not. So you need to listen to me in this regard because it's going to help you once you are out there in the trenches. When you have real risk, when you have a real potential to blow your account, have drawdown, what are you going to lean on when it feels like you can't breathe and anxiety is gripping you and you just can't stand it anymore and you want to collapse the trade because you just can't hold it anymore? You're not even in a losing position. Sometimes you're going to be in a position where you're making money, and it's harder to even think then because it's just taking off. You didn't have a limit order in. It just started running, and now you're thinking, what do I do now? You learn that by looking at these live streams and spending time with me, because we're not surprised. We're not surprised. Do you hear any surprise in my voice? Do I sound like any of this was a shock? Like, look at this. Can you believe this? We're down here in this new week opening gap right here. Who would have known this? How could anyone have guessed that it was going to perform like this? It's old hat, and it's going to be old hat for you. And you'll have these same memories pop up because you've spent time with me. And you'll hear the things I've said during these live sessions that is going to be anchored in your understanding. Your memories are going to be rooted in these endeavors. Not from a book, not from a video that I talked about a conceptual idea, static, in hindsight. Watching it live over real-time data. That's experience, folks, and you can't fake that. It's either there or it's not. It's either correct or it's incorrect. The logic is sound or it's not sound. And I hopefully have been communicating, at least in my opinion I have, been presenting enough evidence to suggest that there's something different that I'm doing that warrants your closer attention. And if you want to make a lot of money and avoid blowing your account and going through all of the turmoil that every live fund trader goes through and be able to navigate that, you found the right person to listen to. I'm not going to try to sway you with materialistic things. I'm not trying to convince you to get rich overnight quick. I'm teaching you how to submit to time. Submit to a process that's logical, that makes these markets book. What makes these markets move around? I'm teaching you that. You don't have to subscribe to the idea that there's an algorithm if you don't want to. You don't have to. You just use these concepts and say, these things are what I believe in. Fine. If you do that, you're still going to end up in the same place. You know, it's fine. That's what I want you to do. Submit yourself to these ideas and keep the algorithm part out of your mouth. Don't even worry about it. If it's a struggling point for you, don't even refer to it as such. It is what it is. But if it's a struggling point for you, just don't even talk about it. Dollar index is flying high here. We've cleared those levels and up into that gap I mentioned. That was yesterday evening, New York local time. And the high on the candle at 445 for dollar index is 102.58. Am I saying that right? Hold on here, make sure I'm doing that right. Yeah, hold on. Yeah, 102.58, and we've traded up to a high of why can't I see that? 102.63 and a half. So we had a nice run there. So we've traded into buy side. We went into 3 premium arrays on dollar. We took out 3 lows on ES, which is, well, we not take out 3 lows. We made 3 lower lows. We had this low, which was lower than that one, and then we had this low here. This low falls short of the new week opening gap low. At the same time, we made low, lower, lower low. The dollar index has made its run up into 3 premium arrays. It's the high on your 15-minute candle of DXY dollar on the 445 from Wednesday, 4:45 p.m. that comes in at the 102.58 level. There's buy side there. And then to the right of that high on the 15-minute time frame for dollar index. And I know this part aggravates some of you. Like, can you just show the chart? No, you need to do this while you're watching, because I'm looking at it just like you are. And you're going to be doing this on your own anyway. But then the gaps that are in the 7:30 and 6 o'clock from Wednesday, those actual gaps there, that's a liquidity void, a real liquidity void. There's a premium array there relative to where we were talking earlier. And then we have the highs formed at the 8:45 time window this morning, which comes in at the high on, this is 15-minute time frame again on dollar. That is 102.45. Okay, so we went through 3 premium arrays and we took out 1, 2, 3 lower lows, and look at the price reaction here. So if you have 3 elements of liquidity tapped into, and you're seeing a low form at a logical level, which was what? Consequent encouragement. Then we have the lower low, the body's respecting consequent encouragement. The market drops again, taking out that low here, and with dollar index, trading into 3 premium arrays. What's likely to occur? There you go, retracement. What time is it likely to occur? Going into the 3 o'clock hour, you have what? This macro unfolding here. What's it reaching back up into? New week opening gap. I'm sorry, opening range gap. And right in here, remember I was earlier referring to this area here where it could trade up into that and then go lower, and it's permissible. That liquidity right now is where all trailed stop losses are. This one has already been taken out, but it's also here now. So make sure this high here on this candle at 4,000, that's noted. So nothing's a surprise, okay? Not time elements and how many times we go into a area of liquidity. If it's not a run on stops, like as I was mentioning with the dollar index. Let me just show you the dollar index. Thank you, Jesus, right? Man. All right, 15-minute time frame. All right, so here's that high here I mentioned earlier. The 445 high. We traded through that here. This is that void where there's no trading at all. It has one little tick in here. Okay, that's a void. That's a real, absolute, actual liquidity void. There's no trading in there except for that one print there. This and here, and then the high here. So when we were down here, I said we were going to gravitate to here, and then if it goes higher, it can go up into this void, and then this high. We rallied up, cleared all 3 of them, and at the same time, ES trades down into the old low here, new week opening gap rather, high, consequent encroachment, failed to go to the low. What level is this? What level is that? Remember when I was teaching you about inefficiencies? Yes, the 50% is consequent encroachment, but you also have 2 other gradients, 75% and 25%. So it went down to 25 plus a tick or 2 to allow that print to be there because there's a difference between bid and ask. And then we had this rally back up. What did it reach up into? What is this? Let me take this off because we don't need that now. What is that? SIBI. Trades up into consequent encroachment of the wick. Hits it. Complete repricing back up into all of this. What was inefficient here? Buy side. Why? Because it's a down closed candle. It's large to the downside. So it's not offering what efficiently? Buy side. How does it offer buy side efficiently? Price has to go back up through this high to that low, offering movement to the upside. That's repricing over top of sell side delivery, but it's inefficient in the form of buy side. So Remember that not bank, but that paint roller analogy I use where you put paint on the roller, put it on the wall. As soon as you put the roller on the wall, the paint distribution is very thick, it's ample. But as you roll it more and more, it starts to create these little pockets of where paint didn't make its way to the wall, and you have to roll back over top of that. The same thing's happening here. It goes down, but in that movement down, there's going to be small little pockets of inefficiency that you don't see. What does it look like? Well, if we do this. If you are finding this helpful, I would greatly appreciate it if you would give me a thumbs up, because that's an encouragement to me as a mentor that you're learning from what it is I'm teaching and sharing with you. But we're going to look in this down move here, right there. I'm going to take this little annotation out. All right, what time frame are we on right now? We're on a 15-minute time frame. So we're going to drop down to a 5. We can see that range here. We're going to drop down into a 1 minute. Inside of that range here, all of this in here, what do you see? I'll make it a little bit bigger so you can see. In this movement here, what do you see in terms of inefficiency? Remember, that shaded area is a big down closed candle. So it's a fair value gap SIBI, S-I-B-I, sell side imbalance, buy side inefficiency. So what is it missing? Efficient delivery for buy side. So inside of this shaded area, I want you to look real close. Where are the inefficiencies? Here, 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 and a volume imbalance right there. See that? So if we take this level here, see if I can copy that. There's your volume imbalance, high, right there. Market trades up into it. It has to do what? It has to go a little bit past it for what? Efficient delivery, because there's a difference between the bid and the ask. So to get that price, it's got to go one tick at least above it, right? Well, you're getting that there. Trades there, and then we came back off of it. So inside of these inefficiencies, you have to drill down into the smaller time frames. And in fact, I'm not going to do it here, but if you have the benefit of using the 30-minute and 15 and 5-second time frames, you can actually look at this even better, like a microscope zooming in. You remember in science or biology when you're in school, and it gave you those things to look at on a petri dish, and you zoom in. Well, the same thing you're doing here. You're zooming into that, and you're going to target the actual inefficiencies, so how far these price runs can pull back up into it. What's occurring at 3 o'clock that causes this? Like, why does that happen? The bond market's closing. So the bond market's closing has this impact on equities. Sometimes it creates continuation, sometimes it creates a reversal, sometimes it creates a retracement and then continuation. You have to know what you're looking for, where you are in the grand scheme of things in the higher time frame chart, and what is still left to be taken in terms of liquidity or trade to an inefficiency. So I've done more than I wanted to do when I first sat with you today at the beginning of this stream. But if it's been helpful to you, I would greatly appreciate you giving me a thumbs up. It doesn't cost you anything to do that. I promise it won't be seen by anyone. No one knows you gave me a thumbs up. It's completely anonymous. I know some of you are alcoholics and you don't want to admit that you're hanging out with the company of ICT. But I promise you, it would be a great encouragement to me. And I think that's going to be it for today. I think this was a very good live stream. I think it was productive. I would have liked to listen to this as a new student. I would have gotten a great deal of insights from something like this. I probably would have had pages of notes and go back into the recording later on and listen to it again to make sure I didn't miss any pieces of it. So with that spirit in mind, not trying to make it too much longer than it needs to be, I think we will break here with this. And until I talk to you next time, which will be next week in a live stream, I don't know which day. I'll tell you by way of Twitter, when I'll do it. But I'm doing 2 live streams per week because I'm doing interviews with students that are proving they make money. And I'm including their social media contact information. So any specific questions you want to ask them, like, can you show me your certificate for the payouts, or can you take me to an interview that I may not have included in the description below their interview video, you're welcome to contact them, and they can surely just share whatever it is that you're looking for. And that's going to be it, folks. Until I talk to you next time, enjoy your weekend. Be safe.